Good evening, ladies and gentlemen. I don't know if you attended my speech last year, but I was pretty bullish on the price of gold. Do you know where the price of gold was 1 year ago? Same. You're in the silver business, right? You're not in the gold business, yeah. 1650. So currently we're trading at 1950. And Jochen and I, we always have this kind of joke that actually if gold is higher 1 year afterwards, he wears green pants. Otherwise, he has to wear a red skirt if we're seeing a negative performance. So I think we're all pretty happy that gold is up. Although I would love to see Jochen in a red skirt. However, it is a great pleasure being here, and thank you very much to the Michaels family and Zuri-Invest for organizing this lovely event. It's one of the best locations I've ever spoken at. It is a great pleasure talking about my favorite topic, the topic of gold, in the next 2 to 3 hours with you. The title of this year's report is Showdown. And ladies and gentlemen, the world is going into showdown when it comes to geopolitics, economics and markets. Everything that we have previously understood seems to be changing. So we will explore some of the showdowns that we're seeing in markets. But before, let me just thank our premium partners, because putting out such a massive report, as Jochen said, 420 pages, wouldn't be possible to put it out completely for free without the support of our premium partners. So John is here. Thank you very much for your support over the last couple of years. We really appreciate it. And I think, and this is kind of our mission, and there's actually 20 people working on this report, there's quite a lot of rubbish gold research out there. There's research in the gold space that is gloom and doom, everything will go to hell, civil war, hyperinflation, buy gold. Our mission is to make a solid, a proper case for gold. Why gold makes sense in your investment portfolio, what it does to your portfolio. And this wouldn't be possible without the support of our partners. It's not only this report, we're actually doing 14 chart books every year. We're having special reports on gold. So thank you very much to our premium partners. If we have a look at the dictionary for the meaning of the word showdown, you will get the following definition: a conclusive settlement of an issue in which all resources and all sources of power are used, or the laying down of one's cards face upward in a game of poker. In history, ladies and gentlemen, we have witnessed many showdowns, like Alexander the Great versus King Darius of Persia. In business, Coca-Cola versus Pepsi, Microsoft versus Apple. And we're all looking forward to the great political showdown of the young, hungry political upstarts, Donald Trump and Joe Biden next year. And I will explain some showdowns over the next couple of minutes. A great showdown from the world of movies. James Bond versus Ulrich Goldfinger. Watch the movie. It's a fantastic movie. I think it would be cancelled these days because doesn't really fit the zeitgeist. It's not what I would call a woke movie, but it's a fantastic movie. And if you remember the plot, it revolves around Ulrich Goldfinger, the villain of the story. He's a wealthy bullion dealer who is obsessed with owning gold. Later in the film, we witness a big plot twist. Goldfinger reveals his plan called Operation Grand Slam. Goldfinger is not trying to steal the gold, but rather to set off a nuclear bomb inside the United States bullion depository at Fort Knox, rendering the gold inside as useless, and thereby sending the world into economic chaos and increasing the value of his own gold reserves. We're seeing showdowns in the world of sports. Are there any Englishmen here? Yeah, there's some. Probably you remember England versus Argentina at the World Cup, 1986. This game was legendary, chiefly for Diego Maradona's two iconic goals. The first, the hand of God, where Maradona illegally punched the ball into the net, a move missed by the referees, as we all know, but sparking outrage in England. After the game, Maradona told reporters that the goal was a little bit with the head of Maradona and a little bit with the hand of God. But there was also the second goal, you might remember, a stunning solo effort after dribbling past 5 English players. It was hailed as the goal of the century. But beyond the pitch, and I thought that's really interesting, the match carried intense emotions. Why? The reasons for this big rivalry, this showdown, can be traced back to the Falkland Wars. The conflict had ended just 4 years ago, leaving behind a legacy of bitterness and nationalism in both countries. Maradona's controversial first goal fueled a sense of injustice in England, perceived as a symbolic revenge for the war, and intensifying the rivalry between the two nations. And there are real showdowns, ladies and gentlemen, but there are also fake showdowns. I don't know if you're very familiar with the world of professional wrestling. In what they call professional wrestling, the characters are usually divided into 2 roles, the face and the heel. The face is usually the good guy, the most likable character. They're usually brave, honest, and good looking. So I don't know, the ladies in here, this is Brad Hitman Hart. I don't know if, it was the 90s, yeah? If you would still call him good looking, but he's a character. So he was the face, the good guy. And then there's the heel, the bad guy. The heel is always evil, dishonest, or a cheater who's complaining and faking injuries. Sometimes, though, the heel becomes more popular than the face and roles are switched. This is called a heel turn. The bad guy becomes the good guy. The villain becomes the hero. The best example for this is The Rock. We all know him as an actor nowadays, but he started in professional wrestling. He played the bad guy role so well that everybody loved him. And everybody remembers his trademark move, the people's elbow, or the rock bottom, or his tagline, "Can you smell what the Rock is cooking?" But in the world of capital markets, we have identified 3 showdowns that we will talk about in this keynote. The showdown in monetary policy, the showdown East versus the West, and the showdown in the gold price. Now, when it comes to the first showdown, the showdown in monetary policies, the Federal Reserve is playing a game of chicken, as you can see on this picture. By the way, I learned today that laser pointers are forbidden in Switzerland, so actually it doesn't work. Many people would see an eagle here, but actually AI helped us to create that, and that's a chicken. So the Federal Reserve is playing a game of chicken against inflation. Who will budge first? We have hit the point where the Fed must choose between fighting inflation and financial stability. If the Fed chooses the tight road, financial markets will revolt and the carnage in bond and equity markets will continue. On the other hand, if the Fed chooses financial stability over fighting inflation, the Fed will risk losing the credibility that they have painstakingly rebuilt over the last couple of months. Now, when it comes to this Fed credibility, it is worth going back into history. As you know, after President Nixon cut the tie between the dollar and gold in 1971, markets endured a decade of chaos, a decade of stagflation and volatility. That was launched by the Federal Reserve under Paul Volcker, who effectively replaced gold with the concept of Fed credibility. By showing that Paul Volcker was prepared to force the US into recession, to control inflation, he was able to keep the dollar as the center of a global financial system, even though it was no longer backed by gold. Now, ladies and gentlemen, this led to a steady downward trend in interest rates and inflation and gave birth to the so-called Great Moderation. Now, what do we mean by Great Moderation? It is a term used to describe a period of decreased macroeconomic volatility, a time of very low inflation, a time when actually, as you can see on this chart, on a decade average, inflation numbers went down and down and down. It was also a time when we saw relatively stable economic growth, few recessions, and it went hand in hand with the unipolar moment in global politics. You remember the end of history and the age of globalization. After 2 decades of near zero interest rates, coinciding with exponential increases in world money supply and debt, the time has now come to pay the piper. Ladies and gentlemen, the era of the Great Moderation is over. My friend Kevin Muir recently said, the 2% inflation target behaved like a ceiling. In the next 20 years, the 2% inflation target will become the floor. Now, why is that important? Because a generation of asset managers grew up during the Great Moderation, and we all got used to this environment of low inflation rates, of constantly falling inflation rates. Actually, for portfolio construction, inflation was the least concern. So now nobody really knows to navigate in an environment of structurally higher inflation volatility. Now, Jay Powell did a good job over the last couple of months. I have to admit, I wouldn't have believed that he would be able to hike interest rates up to this level. And he also created a very, very powerful narrative. So I think from a marketing perspective, he did a tremendous job. He should be nominated for the Academy Awards because he repeatedly used the keeping at it phrase at his speeches. We want to act aggressively now and keep at it until it's done. Why did he use it? Because that was the biography of Paul Volcker, a fantastic book, by the way. So he was always referring to Paul Volcker to basically create the narrative that he, Jay Powell, is the next Paul Volcker. I said in an interview a while ago, Jay Powell is the new Paul Volcker, would be like Danny DeVito is the new Brad Pitt. Now, actually, through my work of research, when I researched the world of professional wrestling, I found a picture for some reason of Danny DeVito in a wrestling fight. Anyways, let's get serious again. Ladies and gentlemen, today's investment environment couldn't be more different because of the vastly higher interest rate sensitivity. Powell doesn't have the toolbox that Paul Volcker had. When Volcker was hiking rates up to over 20%, federal debt was merely 35% of US GDP. Today, federal debt is 123%, and it's rising fast. In 1980, the Fed's balance sheet was 160 billion. Currently, we're at 7.9 trillion. In 1980, total US non-financial credit was 3.9 trillion. Now we're at 70 trillion. In 1980, the net international investment position was plus 10% of GDP in the US. Now it's minus 65% of GDP. And Paul Volcker had the full support of the White House. If we're moving into recession, especially in an election year that is coming up, I'm not sure if Jay Powell really will have the full support of the White House. Have a look at this chart. US government debt is up 10 trillion since the year 2019. US federal budget deficit is currently 8% of GDP. This is the biggest in the past 100 years outside of a war and a recession. And on this chart, we're not showing net interest expenses as a percentage of GDP, but rather as a percentage of tax revenues, because this is what government is actually taking in. And you can see those are the forecasts by the Congressional Budget Office. So an official institution that is forecasting that actually until 2050, net interest expenses might become 35% of all US tax revenues. So when Janet Yellen recently said fiscal responsibility is a priority for President Biden and me, I'm not sure what fiscal irresponsibility would be for Mrs. Yellen. But I think this clearly shows how detached from reality public officials and fiscal stimulus at the moment is. And ladies and gentlemen, when it comes to the big R word, the recession, we've been in the recession camp for way too early, I have to admit. At the beginning of the year, we said we will move into a recession in 2023. So this year we went from hard landing to soft landing to no landing to higher for longer. Those were the narratives this year. I met Dave Rosenberg last week at a conference in Lisbon, and he said, every recession starts out looking like a soft landing. And if you follow some of the economic indicators that we do, like this one, for example, the leading economic index, that is not looking into the rearview mirror, but looking through the front window. It is a leading index. It actually has declined now 18 months in a row, which is the third longest decline in the last 70 years. If you have a look at this chart here, since 1960, actually it forecasted every recession. And every time the leading economic indicator was down for more than 6 months, we moved into recession. As I've said, we're now down 18 months. Credit, ladies and gentlemen, is the lifeblood of modern economies. So deteriorating credit conditions are both a signpost and a cause of recessions. Have a look at this chart showing credit growth. Usually when credit growth momentum just weakens, chances are high that we're moving into recession. Actually, now we're seeing negative credit growth. So credit is contracting. Since 1975, we've only seen it once, 2008, 2009. So that's a big red flag from my point of view. And we've got a gazillion of other recession indicators. Obviously, the yield curve. So our call is pretty strong. We're not in the soft landing camp. However, a recession is not the end of the world. And let's reflect what actually works in a recession. That was one of the key topics of this year's In Gold We Trust report. We introduced the Incrementum recession phase model, where we said that every recession actually is different, and every recession has 5 distinct phases. So we crunched the numbers and wanted to analyze which asset performs best in which stage of a recession. And actually, gold is a pretty reliable recession hedge. On average, gold is up 10.6% over the course of all recessions since the year 1971. Silver, equities and commodities have a negative performance during a recession. And interestingly, mining stocks show that not all stocks are showing negative performances during a recession. Except for phase 3, mining stocks show a positive performance on average. But what you can also see on this chart, in phase 4 and phase 5, basically all of them show a positive performance. And this is usually the moment, phase 4, when politicians and central bankers really start panicking. Because usually recessions are officially announced once the worst is already over. So the 2008-2009 recession was actually officially announced in March or April of 2009, when the worst was definitely over. So phase 4 and phase 5 will be the points in time to really get aggressive again. The second showdown that I want to talk about is the showdown East versus West. Throughout history, we've seen this showdown. Alexander the Great versus Darius, the Crusades, and of course the Cold War. What we're seeing now is a showdown in geoeconomics between the saturated establishment and the hungry upstarts. It's like the small brother that is really growing up very quickly, but he's not taken serious by the big brother. A central example for this development is the growing importance of the BRICS, which have in 2020 taken over the G7 nations in terms of share of global GDP. And this will only accelerate with the addition of 6 new members: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. By the way, they will be responsible for 50% of global oil exports. So this development will even accelerate. And ladies and gentlemen, I know that before the BRICS summit in South Africa this year, there was big excitement in the gold community because there was a tweet coming out from the Russian embassy in Kenya. So I think once we read news about the Russian embassy in Kenya, we should take it with a grain of salt. I'm not so sure about the informational value, but there was great excitement over a gold-backed currency in the gold industry. However, if we dig into the growing importance of gold for BRICS, it is evident that gold actually plays a major role for BRICS. Have a look at this chart. Emerging markets have been increasingly building up gold reserves and reducing dollar reserves since 2008. Last year, central banks bought 1,100 tons of gold, up 152%, the highest amount ever. And in the first 3 quarters of this year, we're seeing similar interest, actually up 800 tons. Now, what was the trigger? Obviously, it was the decision of the West in February 2022 to freeze the dollar and euro reserves of the Russian central bank. This will go down in monetary history. Yes, we have seen sanctions against pariah states like Venezuela, against Iran or Afghanistan, but never have we seen sanctions against a state with veto power in the United States Security Council, a former member of the leading economic nations, a nuclear power, and one of the world's most important exporters of raw materials. So the decision clearly demonstrates to many US critical nations, and there are quite a lot all over the globe, how quickly US dollar reserves can transform from a highly liquid asset to useless pieces of printed paper. And this surge in central bank buying also shows an erosion of trust in institutions, agreements, and the rule of law. Now, more and more countries will reconsider the allocation of their reserves. The volume that we are talking about is enormous. The global foreign exchange reserves of central banks amount to 12 trillion US dollars at the moment. The majority, obviously, is in dollar terms, 60%, 20% in euro terms. So, ladies and gentlemen, gold as a neutral monetary reserve has emerged as one of the key beneficiaries of the troubling conflict between the East and the West. But it's not only central banks that are buying gold like crazy in emerging markets. It's also private gold demand, which is dominated by the East. And this was a large chapter in this year's In Gold We Trust report because it's important. We here probably think that we're the center of the gold world. We're not anymore. Just to give you a couple of numbers, China and India have gone from 28% of consumer demand in 2000 to now 50% of global gold consumer demand. India imported 17,000 tons of gold in the last 2 decades. Total gold stock in private hands in India is 29,000 tons. This is actually more than the combined gold holdings of the top 27 central bank gold holders in the world. It is said that Indian housewives own more than the 8,100 tons of gold that the US actually owns. Coming to China, China gold imports in the last 20 years were 18,000 tons of gold. And while the official gold holdings by the PBOC might be low, a little bit more than 2,000 tons, a Chinese official recently said when asked how much gold China has, he said, China owns gold through its people, which is very, very revealing from my point of view. So the flow of physical gold has shifted from west to east in recent years, led by India and China. And ladies and gentlemen, the price of gold is increasingly being made in Shanghai, in Mumbai and Dubai, and less in Zurich, London and New York. So are we seeing the renaissance of gold as a central bank asset? From my point of view, central bank gold demand will become one of the main drivers of this next bull market. In the 1980s, gold as a percentage of reserves was more than 75%. Will it go back to that level? Probably not, but it could easily double to 30, 40% over the next decade. And of course, it went hand in hand with the Great Moderation, where central banks all over the globe said, well, actually, this gold sitting in our vaults, it's pretty useless. But we have seen, as you know from the world of professional wrestling, a heel turn, ladies and gentlemen. Gold is slowly coming back into the system as a neutral reserve asset. Now let's talk about the showdown in the gold price. Question is, are we prepared for this showdown? Well, many people keep telling me gold didn't work. As I've said, 1 year ago, gold was at 1650. Now we're trading at 1950. I would say it's quite decent. Have a look at this. You know, it's a table with lots of numbers. Obviously, green is positive performance, red is negative. We're showing gold in many different currencies because gold actually is a currency. And so from my point of view, gold did its job pretty well. In US dollar terms, year to date, up 7.1%. In euro terms, 7.4%. In Japanese yen, the Japanese yen used to be one of the most important currencies out there, up 23%. And the compound annual growth rate of gold since the year 2000 is 8.4% per year. It's not too shabby, I would say. It's definitely by far the best performing currency and one of the best performing asset classes in that time frame. And my friend Shane McGuire recently said, I don't think the question really is what is gold worth, but what currencies are not worth. And as you can see here, you should be happy living in Switzerland. The Swiss franc is definitely the least dirty shirt. As you can see here, gold is up only 5.8% compound annual growth in Swiss franc terms, but still, it is up. So ladies and gentlemen, I think gold did a pretty decent job over the last couple of years. Now, one of the most interesting charts in the gold world is this huge divergence that we're seeing between TIPS, so the inflation-protected funds, and the price of gold. Usually the correlation was 91%, so very, very tight correlation. Look at this divergence now. If you would have told me 1 year ago that real yields would rise 350 basis points, and you would have asked me where's the price of gold going to be, I would have said 1,500, 1,600. So the fact that the price of gold is holding up so well in an environment with huge headwinds, like a surge in real rates, that's a sign of strength. Now, if we have a look at this chart, I think it's telling us a couple of things. First of all, when did this gap widen? It actually started to widen with the Ukraine war, which led to those record high gold purchases that I talked about before. And what it also tells us is that gold is kind of calling BS on the official inflation numbers. And I think that gold does not really buy into this higher for longer narrative. It's not really buying into this belief that inflation numbers will collapse very quickly and that over the next couple of years, inflation won't be of any concern. So if you have a look at this chart, it might be evidence for de-dollarization or de-euroization, but not into renminbi or rupees, but rather into gold. Now, where are we heading to? This is actually not my father. Somebody said, he looks a bit similar like you. Gerd Fröbe playing Ari Goldfinger. What should we expect for the next couple of months? Well, it's interesting, ladies and gentlemen, to see another big divergence between the East and the West. Have a look at this chart. It shows the demand for gold ETFs. And actually, it seems that Western financial investors that buy the ETFs for their portfolios, they have not participated in this rally. So global gold ETFs have seen 6 consecutive quarters of outflows. In 2023, we saw outflows of 189 tons. And as I've said, there's a discrepancy between the East and the West. Europe and North America have sold more than 200 tons, while Asian ETFs saw inflows of 14 tons. So from my point of view, those Western financial investors that buy gold ETFs, they are very pro-cyclical. And I think at one point, when we hit new all-time highs in US dollar terms, I think that FOMO, fear of missing out, will kick in. And I think this might be the marginal buyer for the gold market. Briefly talking about the mining stocks, to give you some hope. Well, actually, from a seasonal point of view, actually buying in November, and then you can see November, December, January, and February. From a seasonal point of view, that's the best seasonal time. However, if you have a look at this chart, we're slightly below the all-time highs in the gold price. But when it comes to mining stocks, they would have to rise 183% to get up to those 2011 all-time highs. Now, Warren Buffett said that the stock market is a device for transferring money from the impatient to the patient. So we got to be patient, although it's easier said than done. But have a look at this chart. It shows the risk appetite in our industry. And I'm using 3 different indicators. First of all, the silver to gold ratio. Normally, if there's risk appetite coming back, you would like to see silver outperforming gold. We don't see it yet. The second one, GDX versus gold, so mining stocks versus gold. You want to see mining stocks outperforming gold. We don't really see it yet. And the GDXJ, to give you at least a tiny bit of hope, the GDXJ, so the small caps versus the larger caps, at least they're kind of stabilizing. But what I want to say with this slide is actually, it's a tough time out there. It is tough. But actually, as one great investor once said, you make most of your money in a bear market. You just don't realize it at the time. Now, I know it's easier said than done. Buy low, sell high. You know, picking the bottom. It's not easy, but I think we're very, very close to such a setup. But as you can see from risk appetite, it's not really back yet, unfortunately. Now, I'm already coming to one of my favorite charts, and this will give you some hope. Now, we crunched the numbers and analyzed what happens to gold when the Fed stops hiking rates. From my point of view, we have seen the ceiling in interest rates. As one can see from the chart, Fed rate hikes, pauses lead to rate cuts, and gold anticipates those cuts, as easy as that. And actually, the performance of gold, once we saw a pause, was a positive one, up 66%, then up 189%, and then up 50%. So what I want to tell you with this chart is actually the fact that gold is holding up so well in an environment where not only interest rates are going up, but also official inflation numbers are going down dramatically. That's a sign of strength. So probably the best is yet to come for gold. I'm already coming to a conclusion. Ladies and gentlemen, decades of disinflation, the great moderation, have ended. And in this year's report, we had a huge chapter about inflation dynamics, how they're changing. I think that we should expect more inflation volatility. We've seen an inflation shock, a rate shock. The next one will be a recession shock and a pivot. Ladies and gentlemen, simplicity is the ultimate sophistication. I know many gold dealers that say, you only need gold. Gold is the solution to all your problems. Gold is like a religion. No, it's not. Gold works from a portfolio point of view. If it's 10, 15, 20%, whatever. But I think it's important to make a sober and honest case for gold. And gold does its job pretty well. Gold is a simple and effective and a reliable means to hedge against inflation volatility, against equity and recession risks. Now, for the next 12 months, I'm seeing gold at $2,300. Otherwise, we'll see Jochen next year wearing this red skirt. I kind of look forward to that, just for the sake of it. And based on our technical target, we can see $2,700. Now, this brings us back to James Bond, when he faced off against the legendary villain, Auric Goldfinger. Ladies and gentlemen, you don't have to be a Bond villain or a professional wrestler, but you could have the Midas touch, a little bit like Diego Armando Maradona, turning some of your percentage of your portfolio into gold. Thank you very much for attention. I hope you did enjoy it as much as I did. Thank you very much.